We have some great questions here. Let's start with Chris. Well, he has the mic. Are gold and silver equities becoming more relevant for the generalist versus ETFs and options on the metals? What do you think, Chris?
I don't think so yet, and I think that's the opportunity. I mean, even just anecdotally speaking, I think that the general kind of retail market hasn't really caught up with the gold price yet. I think just, from talking to people, just, my father or the architect who came into my house the other day to talk about redoing the kitchen or something. It's so, you do go. Oh, what do you do? Oh, I'm a gold mining analyst. Oh, gold. What's the gold price? Where is it again? Like that kind of thing. So, and even people who work at my firm, Gabelli, which is a broad generalist firm and has $35 billion under management. So other analysts who cover other sectors, they kind of ask me, so what's gold doing now? It kind of is up, right? So I don't think it's that gold equities have got an interest from generalist investors yet.
Let's talk about the cycles, Chris, because those of us, all the gray hairs now for so many decades, this current cycle, we thought, here we go, we're breaking 1,500, and here we go. Rob McEwen's using his 5,000 an ounce slide again that he stopped using for about a year or so. But how about this cycle?
Well, I think what's interesting, because you mentioned ETFs and options, or I guess it's more so futures. But this cycle, what we've seen is a real increase in flows into ETFs, into gold-backed ETFs, and also an increase in the net speculative position in the gold futures market. And what that tells you is that speculators on the bleeding edge are buying in first. And so what we'll need to see is the average person, like I was talking about before, the retail investor, well, first, the generalist investor at Gabelli, or another place like that, then the retail investor, and then that's when gold really has its move. And I think that'll happen if it becomes more and more apparent to the average person that short-term rates are going towards, in the U.S., are going towards zero and even negative. And it'll really happen when people wake up one day, again, people like my father, say, an old retired guy, goes, looks at his account and goes, wait a second, so I'm paying, I have my money in treasuries, and why does it say negative? Or, and I think that's when the gold thing really, really starts to run.
Eric, we're hearing a lot of great presentations, company presentations these 2 days. In this market, give us the description of a junior that you think will do well.
Yeah, I think it's we're all hopeful that gold continues to move in a good direction, but I think it's very important to focus on juniors that have a good position on the cost curve. That's obviously critical in base metals, but it's as critical in precious in our view. And with all deference to the likes of Rob McEwen and others who spent a lot of time in their presentations talking about how the gold environment's going to improve, what you really want to be involved with is a company or companies that can make good money at 1,200 gold, that can break even at 1,000 or 900 gold, especially in the junior space where you have projects that need to get financed, down the road, and it's hard to predict what's going to happen. Now, some of the current economic turmoil should support, good ongoing gold prices, but with potentially credit getting squeezed and the like, a lot of projects will require more in the way of equity. I can tell you when we're financing gold companies right now, we're basing our own internal models and return expectations on 1,200 minus as opposed to 1,500 plus.
Eric, what is the typical platform you do the financing off-takes or stock? Or?
We typically will do equity. We can do anything. We can do credit. We can do streaming and the like. But we find that our interest is most aligned if we come in on equity and keep a simple capital structure and work toward everybody winning.
Michael, let's turn to you and let's ask about allocation. Gold, silver. I personally don't know if you're the gold direction, silver direction, but let us all know, please.
Well, at the moment, we're about, I would say, 75% in the gold direction. I think we've done well. We've established, I would say, a lot of new positions last year around November 18, which has paid off very well for us. But we haven't seen as much as appreciation yet to the silver companies as we hope it would, even though we know that silver itself is going to be more diversified in the tech space in the future, so we think there's going to be even more upside. And I think sometime next year, we're probably going to be making more 50-50 split, as we've seen. But we just haven't found specific silver companies that we think that will give the upside we got in the gold companies recently.
Well, just this week, I recall reading a newsletter earlier in the week. The flavor of it was we're being disappointed again with silver.
Correct.
A false start. Do you want to elaborate on the situation with silver? I'm quite surprised that the price is still where it is.
I agree. I mean, the way we've seen the run, I just don't think the street is giving enough credit. Again, I'm sure guys like Chris or Ryan or anybody would say that it's hard to find good players that actually is going to make sense and make money for on the production level and so on. From the true players. I mean, the big names obviously have been out there that done okay, but I don't think there has been meaningful results yet. And a lot of companies just started making money because I think a lot of them were still breaking even at one point. So if we see a little bit more and the silver price get to maybe mid-20s, I think we'll see a little bit more appreciation in the standalone silver companies.
Well, Ryan, you're, of course, a portfolio manager. What trends are you looking at? What are some of the glaring trends right now in the way gold is trading, and how are you viewing the market?
Sure. No, I think one of the biggest things, that I'm sure that everyone's witnessed is just the change in sentiment, in terms of the likelihood of recessions, U.S. and worldwide, and the trajectory of rates. And I think, December, that clearly changed for everything, and that changed the dynamics for gold and silver to some degree, although not as much so far. But that's what we're really watching. I mean, we have clients around the world, and it's very interesting to look at and see what the European clients are doing versus the U.S. clients, because the European clients have been in this low to negative rate territory for a while now, and so they're very much ingrained in it. Whereas the U.S., it's very much in its infancy, I would say, when we speak with investors, particularly large investors who take a long time to make position shifts, and particularly gold. I mean, you really have to really risk your career almost to put 0.5% into gold, it feels like. And that's what we see. And so to me, the biggest trend is that people are looking for alternatives, particularly to the S&P 500, which I think most would say was highly valued. But they don't know what to do yet. But gold is definitely one of the alternatives they're thinking about, and they're thinking about how to do it. But I can tell you, they're not going to do it until the S&P 500 rolls over. To get back to the equity point of view, you've seen gold do very well, and as Chris pointed out, you've seen the people at the very leading edge of speculative trading focus on bullion. But if you look at the equity side, in our minds, our models, it's discounting $100 or $150 less than what the current spot price is. So from our perspective, there's a huge opportunity there on the equity side for starters, and then if you really want to get into it, it's really on the junior end of things. Because in our view, one of the trends will probably be if the market doesn't adjust itself, the bigger companies will adjust it for them.
Eric, let's go to the M&A area. We were seeing some eye poppers, and this current market, how do you view the M&A activities going forward into 2020?
I think it's pretty attractive for large cap acquirers, given how depressed the junior space has been, I mean, it's a bit like the biotech industry where big pharma wants the little guys to do all the work and spend the money, and then roll in, and they can afford to pay a lot. So, we've seen that starting to happen in the junior space. In Australia, for example, there have been some notable transactions recently, and that's notwithstanding, a pretty good run up in the Aussie dollar gold price, more so even than the U.S. dollar price.
Well, we've interviewed on the radio executive with Newmont and Rob McEwen as well over at, of course, McEwen Mining. And the giants, being Newmont category, they have to go the M&A route to replace their depleting reserves. And Rob McEwen says that as well, that he's going to get on his S&P dream, chiefly by the M&A strategy. So while we're still on that, let's go to you, Michael. Do you see? I see some low-hanging fruit amongst some of these companies that are presenting. One this morning, I won't name that, but I was saying how long. Do you see any low-hanging fruit in the M&A area that is quite interesting to you? Any?
Yeah, I mean, there's probably two companies I would probably say there are potential, but I think there's two key points to each one that has to make sense. So one is in the lithium space. Millennium Lithium, we're a shareholder. I think once we'll see a little bit more improvement in the lithium price. I think at this stage where the company is, either they have to build or put them for sale, right? It's a very strategic move, has to make sense where the company trades. But the timing's gonna be everything, I think, gonna be tied into the lithium price. And another company, we've been a long-time shareholder. I don't know if they will sell today or not, but I would like to. I mean, I'll say the name, it's Mag Silver. I think it's a great management. It's a great team, well developed. But I would like to see it because I think that's going to show a spark in the silver space, as we discussed earlier, in terms of how the next stage will phase, especially from M&A acquisition. So we haven't seen that in the recent space, particularly in the silver, but I think that could be one potential we would like to see, but they could develop and take it to the next stage, the company themselves.
Let's get back to economics issues before. Of course, everywhere we look, we have, and I'm going to just let one of you take, whoever wants to take this, the debt loads are becoming, of course, we know the U.S. government situation, but commercial, consumer, how do you see in the years ahead, with the Treasury pumping money, almost zero interest rates? Does anybody want to take that about how this could economically impact? We're hearing the word recession, how that could cause a recession, how it could crucify the stock market, and what that might do for metals. Does anyone want to?
I'll give a
Yes.
short reply.
Yes.
I'm not aware of any time in the history of humanity where excessive free credit has resulted in long-term sustainable progress. So, the question is when. Markets are certainly reluctant to predict timing, but ultimately there will be a credit cycle. And in terms of its impact on the gold world, it's certainly not going to hurt and could help the metal itself. But in terms of particular mining companies, we saw even big miners got in trouble in the last cycle, and it was devastating for juniors with respect to their ability to progress projects without access to debt, or those that had marginal projects had trouble with their debt. So I think it's hard to predict how it's going to shake out, but it should not be as negative in the mining sector as it will be elsewhere. But it's hard to say that a day of reckoning is not coming at some point.
No question. Michael, or Ryan, go ahead.
Yeah, I'll add to that, actually. I mean, I think the point being is, timing is uncertain, but, I think everything is so finely balanced. And I think that's the critical element. I mean, we certainly have less room on a debt side. I mean, debt GDP in the U.S. is twice the level it was 10 years ago when we had the Great Recession. And if you think about where the rates are, Fed rates are now, they have a little bit of room now, but not a lot. In Europe, they have no room. And then the other major economy is China. And I think the one point I'd make about China, I mean, if you look at the money supply growth there, which we look at, it hit 0 in January this year. The last time a major economy hit 0 money supply growth on the M1 factor was the US and Europe in 06 and 07. And if you think about China, China was a huge savior from the Great Recession. And they're sort of, reorganizing things over there. So to me, it's very unclear that you're going to have much of a savior if anything does happen. And I think that's really, on the macro side, what we focus on is that the likely intervention is certainly probably going to be less. And I don't think, frankly, just given the way the politics have gone around the world, I think people's appetite for significant bailouts of what probably will be a rich phenomenon in terms of bailing people out of stocks and so forth, it's going to be much less than it was 10 years ago. And from the gold side, it's its own currency, so you don't have to worry about debasement and that type of thing, which is probably likely.
Michael, did you have a comment? In the 1980s, and of course, I'll never forget. I was I was on the Nightly Business Report, one of the hosts with PBS, and I interviewed Ronald Reagan, and I asked him about the gold standard, and he gave the most beautiful. It was like a professor lecture about fiat currency, but the classic takeaway was, there has never been a currency that was fiat currency, and then he said imitation money, leaning into towards the camera, that has not survived in time. The fiat currency backed up by faith, right? Let's turn it to some questions and answers. Anyone here in the audience? Yes.
We hear at these conferences a lot of management teams talking about how their second asset and down the pipeline gets no equity value. And obviously you own a stock, you want those assets to have value, but when you buy a stock, how do you think about that in the market? And do you think that we've gone into a new world where those second assets and third assets are basically treated like VC? Does anyone think I need this? Yeah, like they're not worth anything until you prove them, so they get 0 net asset value in a model. Could you guys talk to that a little bit and your thoughts, whatever?
I would just say that you can value those really as an option value really at this point. And what I was going to say for the question relative to where there's opportunity, I do think there's such a dearth of financing available right now in the market for development stage projects that if I were to like juniors that we own are mostly producing juniors, and where we think that they can grow on their own without having to access capital, or we'll own like production, like companies that are in a development stage and actually have raised the capital by hook or by crook, and so we're kind of hoping that once they come into production that they'll re-rate. So if there's a company now that has say 2 projects and they're focusing on one and neither has the capital, you know what I mean? Then it's like, I guess that's part of the question. Are you saying like, is it one that's producing and then has like a non-producing, or are they both non-producing?
Gold, I have 2 mines. They're both in reasonable jurisdictions. Everything reasonable, and my NAV for one is $100 million, and the market cap's 90, and so my PNAV's 9 times or whatever. And then they have this other great development asset. It's got to be worth what? What's it worth? It's for 0.
Right. I think from my perspective, it's dependent on the value to a large degree is dependent on how much equity they'll need to raise and whether or not it's even available in the market. So if it's like a high cost project that's like way down the road, and big capex, not really economic at the current gold price, then yeah, it's not really worth much. Now you might be willing to value it at a certain price because you think that the gold price is going up, so you're like, okay, I'll pay a little bit for that option. But I think in today's market, the question really is, how will they be able to access the capital to get it built. And if it's not really apparent, then it's really not worth much in today's market.
Yeah, I would add a little bit to that. First of all, if you're buying something at 90% of NAV, looking to clip the extra 10%, that's not a great investment in the junior space. So you need to ascribe some material value to the upside potential of project 2 or 3 in order to make it investable, in my view. And then the second point is if the second or tertiary project does not have a well understood resource that structural controls on geology, plenty of drilling. You may not have a published resource yet, but you need to be able to understand there's something there that seems likely to be economically mineable. Without that, it's worth zero. There are too many projects out there that are could potentially be something, but aren't worth anything yet.
Yeah, I would add one more thing. I mean, there's a perfect company to your example. I don't know if you guys know Cisco Mining, right? Acquired, I think, in 2015, a bunch of companies that are low-hanging fruit for cheap valuation. But now you build a portfolio like a private equity model. The question is, which one is going to lead the way and unlock the value? I mean, I think there's going to be a point they're going to have to sell the assets off and use that capital to actually take the next one to the stage, which is kind of smart. I see my way, where you have non-dilutive, could be capital be used. But traditionally, over the years, I mean, I remember 2011, you could have 3 projects. So one is in Alaska, which is probably going to be a capex $1 billion. Then you have something in Peru. I think sometimes companies go spread out and they think they find cheap assets. But once you're in so many different jurisdictions, it depends who values what, right? Like I like North America and Latin America and maybe one part of Africa, right? But I will not invest in companies that have 3 different assets around 3 different worlds. Like what's your main focus in management? Unless you have main expertise, everybody has jurisdiction risk, and people do need to sell it off. I mean, and focus on one. It's not like biotech company, right? You have one lead drug that fails, and your whole company collapses 90%. Here, if you have a production failure or something, the stock could go down by 20%, and hopefully make it up in the next quarters and so on. But it's important to be focused on one asset. And that was a lot of the mistakes I've done in the past. And I think certain managements got smarter and focusing on the key core assets and actually develop to the next stage. So it's a must to sell off. Hope that answers your question.
We call it a one-trick pony when you're not spread around a little bit. Yes, Tom Dean, Murdoch Capital.
You mentioned companies that are not capitalized as being dangerous investments. Doesn't that offer you an opportunity as fund managers to make that investment in those underfunded companies?
Definitely. No, I was just thinking about his question. I can think of a couple companies right now where I actually think their main asset is their second asset, and people aren't valuing it at all. And I think I have a strong feel that once people recalibrate to the gold price, because you've had such a big move, and I think you have a different set of expectations for pricing now. And so I think that's going to take a little while to shake out a little bit. But I think they're going to recalibrate it, I would bet. If the equity market's not going to do it, to your point about things not being valued, I think there is an opportunity there. And I think it is more likely that projects will be on the table versus companies. And it maybe end up being the company because it's so cheap, but they'll end up wanting the projects.
I mean, my response to that is we'll let Toqueville do the financing. No,
Thank you, Chris.
no. I mean, it just depends on the risk level that you want to take and your access to capital. Actually, Toqueville is a much bigger fund than ours. They have access to more capital, and so it's like and I think from my perspective, we have to feel the. It's just like, you do have to understand the market in which you're operating. And if we don't have the capital behind, like if we do one financing and then we don't see the capital available, like one thing that we do, I mean, to your point is we have to look and see, are there other shareholders like a Toqueville who are also participating? That's something else, right? So you have to say, so if we're going to get involved, are there other, good funds like Ryan's who have access who are also going to get involved? But I from my perspective, it's hard to it's just the markets. you have to also feel the flow of the market. You don't want to go. Like from my perspective, it's so hard to go against the market that So anyway, that's my. It's kind of.
I think one good point there is if you are into an opportunity with the right partners to have the wherewithal to see it through, right? I mean, it's very different if it's a junior that's going to require $50 or $100 million of equity to get a project up and running and has a market cap of, I don't know, 100, 150 million. You can see with good co-investors in there, you can see that happening under a range of cycles. But if it's a junior that's trying to develop a polymetallic porphyry that's got $1 billion plus capex, it's just not going to happen at that kind of scale unless you have some large deep pockets, and you don't want to be the guy in before those guys show up.
Yeah. And I think that goes to your question too. Is if the second project is this huge project that needs lots of capital, that's the reason why it might not be getting much value. Because again, it's how do you. So it's like, it's there are opportunities, but you also have to like at the end of the day. It's a bunch of rocks in the ground, and unless you can raise the hundreds of millions of dollars to get out, it stays a bunch of rocks in the ground. So, but anyway.
Yeah, the key is to not pay anything for it or very little for it. I mean, that's really the key. I mean, any investment, I mean, the value is first, because if you don't get a reasonable value, forget you can have the best thing in the world, but if you pay 10 times more than it's worth, it's not going to be a good one either.
You're all investing in the mids and larger companies. Do you see the market in the retail side and funding of all of these juniors and near mids and wannabe mids coming anytime soon, or what's your take on which way the wind is blowing?
It's slow, I'll say that. You've got obviously the tier of things. So I think bullion is what Chris hit on first. I think people are there on bullion. Seniors, I think people are there in terms of if they're going to be in the equity side, and then you sort of go down the food chain. I think it's going to be a little while, and you're probably going to need to see a little bit more activity. Probably on the general market side, S&P 500 or something, where you'd have money come in. And the alternative to that would be if gold price stays where it is. I mean, if you think about, if you fast forwarded a year from now and gold is 1,500, the balance sheets of all the producing companies is going to be so dramatically different and better. And then you could see them, and that's what I'm saying, they're going to correct it if the market doesn't correct it. Because you look at the Australians, I mean, they're coming to North America big time. And they've got plenty of money and valuation. And there's a huge disconnect for them. So I think it will take a little time, and I think it might take a few transactions either from some of the people from Australia or some of the cash builds that have happened in the Americas.
Yeah, we actually have seen a lot of UK funds stepping in, and some other European fund managers, which is great. But I agree with Ryan that it's important to see those opportunities where. Actually, I see that when the exploration companies are actually developing to the point where they need to be acquired or actually need to have more capital coming in to increase the value, it has to be a shift of segment. And if the majors have more capital on the balance sheet, that's a definitely way to approach that. But I think, to be honest, I'm sure some retail investors say they got burned so badly in 2012, 13, and so on. I mean, a couple of guys are laughing, but it's true. And it's going to be hard to convince, right? Where's the better opportunities? You go to Canada, it's the cryptos or the cannabis stock, right? It's the flavor of the month that's selling there, right? Until they really have to, again, grant the faith that for retailers to believe again that this is going to actually make money and it's not going to be just another grassroots project that's not going to go anywhere.
Question over here on, yes.
There seems to be a widespread assumption that these shares of precious metals companies are inexpensive. And yet, I think Eric said that we should look for companies that can break even in gold at $1,000 an ounce. I don't even know if that exists. I've heard one CEO say that the whole industry goes bankrupt at $1,000 an ounce. And you mentioned Meg Silver. I mean, is that a cheap stock? I mean, it's selling at about the present value of its project in Mexico. So, I mean, are these companies truly inexpensive at today's prices?
I mean, if you would invest in Mag Silver a year ago, you would have had a different approach than today, right? Which we did, and it took that advantage. Question is, can you find another Mag Silver today that's going to give you the same valuation, hopefully, or at least half of to next year? We had a very quick run in the last couple of months, especially, let's say, from May and on. But what we've seen, equities coming out, capital from equities coming out and actually going to the ETFs and so on. I don't know, because of the way economy is trading right now, to some degree it could be. I think once maybe they pull out of the traditional ETFs and then come back, that could be a way for sure. But like I said, last year was a good timing for anybody to step in October to November to buy.
I think it comes to your question. I think points to like a trend. I think within the industry is, and what's going to drive valuations. I think it's going to be free cash flow generation. So you say this stock, it's cheap, and that's the whole thing. Yeah, XYZ, Moose Pasture X is cheap relative to Moose Pasture Y, and yeah, it's cheap on an NAV perspective, but like the question is, are you ever going to see any cash from that business? And that's what investors are really they're starting to say, look, we saw the gold price go up to 1900 and we never saw any cash. Okay, like now if we see the gold price go up, we want to see some cash. We don't want to say, we don't want to hear you say, okay, yeah, well, we're cheap on our net present value if we raise all this money and we happen to get the stuff out of the ground and it's all like we say it is in the plan, and there isn't a big blockade and the government doesn't take it and all this other stuff. Yeah, it's cheap. So I think what's going to drive valuations going forward is going to be the actual realization of cash flow. So the cheap companies are the ones where I think you can see a distinct amount of free cash flow being generated in the next couple of years, and those are ones like a Detour Gold, which is going to start generating a lot of free cash flow, or even a Pretium, which is so these are like mid-tier or like they're producing companies, and that's kind of why we're still more focused on the production companies because again they'll start to generate some free cash flow.
Just a little further on valuation, if you take a step down the food chain from the likes of Detour or Pretium into the real junior space where you have developers, you take 10 companies that have a $75 or $100 million market cap. They all have radically different value propositions, and it's like being on an airplane. Everybody's paying a different price for their seat, and maybe you're in the $600 economy seat and someone else is in first class for $400. And there really is that much variability. Similarly, if you look at that sample of 10, you'll find guys who have a realistic shot of producing sub 1,000 when they get there, and others who are, they'll tell you they need 1,400, but may need 1,500, 1,600 plus to wash their face with it. So you have to really scrutinize what the financial returns are likely to be, and take a view on the underlying technical aspects of the project, which is not something that lends itself well to retail investors.
I think just the one good thing about having gone through the tough times of the past 7 years or so is that psychologically I'd say people are bent now to be pessimistic, and that's got to create some opportunities in the sense that just as Chris points out, I mean, people aren't going to really believe it until they see the cash, right? So if you have a little bit of foresight into that, you can probably get a step ahead of that, because it's so ingrained. If everyone was optimistic already about everything, I'd probably say, yeah, probably things aren't cheap. But to me, the bias is definitely toward the cheap side.
Yeah, I think there are also, to answer your question, there are cheap companies that are development stage that if they do execute on what they say they're going to do, like for example, a Continental Gold, where we own some of that, which is they say they're going to come into production next year. We believe, I'm seeing them tomorrow. I believe that they will, and at the cost that they say they will, and then it'll start generating a lot of free cash flow. It's a cheap company. That is cheap because shareholders will see the actual cash flow being generated.
Any other questions? Speaking of Toqueville, John Hathaway last week in the Gold Strategy newsletter for the third quarter, he said, buy this dip. And he is talking about a pending breakaway price action. Ryan, do you want to comment?
I'm not going to contradict him.
I think not to. So I'm not going to contradict him either. but no, I think what's interesting is that gold is like we're in this. From a technical perspective, we've had the big run, and it was a lot, based on a lot of speculation, and also it was very correlated with rates. As rates went down, the gold price went up. Now rates have gone up a little bit. The gold price has come down, and so I think now, if you look at the gold price, it's like what I've heard like a technical analyst say makes sense is it's like having a discussion. Like the gold price, it's like the market's having a discussion around gold. It's consolidating. And so I think the question is what's the result of that discussion going to be, or that argument? Is it going to be to the upside or to the downside? And I think that if so it'll either break up or break down. And I think that that's going to be dependent on the direction of that the Fed takes. If the Fed continues to lower rates, I think that gold will break out to the upside. I think if there's a view that the Fed's going to pause and raise rates, I think it'll break down. But it does feel like we are in that position where the Fed, like the economy's slowing, the global economy's slowing. It does feel like we're in that position where it's going to break out to the upside. So I hope John's right, and I think he is.
Eric, Michael?
I don't have anything to add to that.
Okay.
Yeah.
What is your gut feeling, Eric, over the next, let's say, 6 months?
To me, I feel like some of the economic uncertainty has already baked itself into the gold price. We're in a good spot. And again, while I'd love to see it continue to go, circa 1,500 is a fine price for the medium to longer term, in my view.
It is. It is. Ryan, your feelings 6 months ahead?
Sure. Just going back to the contrarian theme here, we had a CEO phone us up maybe a month or two ago and asked if he should hedge some of his production. And I said no. He phoned back the next day and he says he's hedging some production. Because we were the only group out of all the ones he called that said no hedging. And I think that's probably a pretty good sign. And it just tells you that people aren't really there yet. So
There you go.
I would think it'd be good.
Michael?
I think we should probably key factors to watch what's going to happen with the trade war, with the Brexit, the Feds, and there's so much to add on to it. Technically, gold should go up with so much uncertainty in the world. I mean, I'm not surprised it's moving and at a faster pace. Look, we're a family office. We take a little bit longer approach, minimum kind of 3-year holds, and if we feel there's opportunities in these kind of segments, then we'll take advantage. But can we add another $200-300 in gold in the next 6 to 8 months? Possible. But it will factor in with everything. And then, of course, we got the U.S. election coming up. So a lot of things should factor in, and hopefully we'll get a little bit of a bump. So I'm staying optimistic. We're going to be adding more to our portfolio companies and adding to new ones as well in the next couple of months.
Chris, your gut feeling?
I do feel that it's dependent on the direction of rates, and I do think that rates will go down. So I do think that gold's going to go back in 6 months. It'll be higher, but in the short term, there is this big kind of speculative position that's been built, and it hasn't all come off yet. So it could come back down to 1450 or low 1400s. But I do think that it feels like the economy is going to weaken, and that and that rates will continue to decline, and gold will continue to climb.
Very good. Any other questions? Dana, do you have anything?
Well, unless you covered it when I stepped out, is there any advantage to the gold companies that are paying a dividend versus those who aren't?
I think that's I spoke about free cash flow generation. I think that'll be like the ultimate manifestation of the free cash flow generation is paying a dividend. So I think that gold mining companies that are able to show actual returns of capital to shareholders, and shareholders can get a check in the mail, put cash in their pocket. That will be, I think that's what will be a big factor in terms of what drives gold shares.
And if the
Yeah.
dividend is better than the rate you would get at the bank, is that also a more satisfaction?
Yeah, I mean, I think that's the other. We have at Gabelli, one of the funds that I work with is an income fund, and it writes calls on the underlying stocks and then distributes the premium in the form of like a distribution or dividend to shareholders. And it's trading at a premium to it's a closed-end fund. It's trading at a premium to its net asset value. Because shareholders love that concept of gold and income. So if you can have gold and income and rates are going down, I think that'll be a huge theme. Rates are coming down, gold prices going up, paying a dividend. That'll be a huge theme. And that's why I think a company like Newmont actually has the potential to really, really do well, because they're positioning themselves to be that kind of company. Even though it's the biggest, I think it's actually pretty undervalued.
Do you know how many producing mining gold companies you own that produce a dividend?
How many?
Percent.
What percent? Well, that.
Just of your ownership.
Okay, of ours, I would say maybe 15 to 20. Something like
Just one. But not even. They're a royalty company.
Which one's that, Michael?
Franco-Nevada.
Okay. What are some of your big positions, Chris?
Exact same as Chris. And just to say that and not only that, the ones that are giving out a dividend tends to be quite small as a yield, so not much.
Okay.
Last
Very
question.
good. Thank you very, very much. By the way, we interviewed Pablo Martin of 1 to 1 last Friday night. So he did a gorgeous interview that was on Coast to Coast Radio. And check that out. If you need the URL line or anything, just let me know and I'll bump it to you. He was so complimentary about you guys, about your industry and the appreciation to work with you. So it was a great interview. Thank you so much. Thanks to the panel.